The Fed just sent a message the market did not want to hear. Rates may stay higher for longer. And for Bitcoin, that usually means one thing: pressure. Here's what happened. The Federal Reserve held rates steady, but the tone sounded hawkish. In plain English, that means the Fed is not rushing to cut. It's telling investors, don't assume easier money is coming soon. That matters because Bitcoin doesn't trade in a vacuum. In the short run, Bitcoin is heavily influenced by liquidity, real interest rates, and investor risk appetite. When the Fed keeps policy tight, borrowing stays expensive, cash becomes more attractive, and speculative assets like crypto can lose some momentum. Now, why is this important over the next 90 days? Because markets are constantly pricing the future, not just the present. If traders believe the Fed will delay cuts, Treasury yields can stay elevated, the dollar can strengthen, and liquidity can tighten further. That combination is often bearish for Bitcoin. But there's another layer here. Analysts are split on what comes next, and that uncertainty is a big deal. If new inflation data comes in hot, or the labor market stays strong, the Fed has more room to stay cautious. That would likely keep pressure on Bitcoin and other risk assets. On the other hand, if inflation cools faster than expected or growth softens, the Fed could be forced to pivot. And that would be a much better setup for Bitcoin, because easier policy tends to support asset prices across the board. So the big takeaway is this. This hawkish hold is not a crash signal by itself, but it is a headwind. Bitcoin may stay sensitive to every inflation report, every jobs number, and every Fed speaker from here on out. If you're holding Bitcoin, this is the kind of macro environment where patience matters. Watch liquidity, watch yields, and watch the dollar. If you want more clear, no hype breakdowns on Bitcoin and the Fed, hit like, subscribe, and turn on notifications, because the next data release could move the market fast.